The S&P 500 is probably half as volatile as what you've got right now. I wouldn't be in what you've got right now for anything. I don't have a dime in a portfolio that looks like that, not one. I don't play single stocks, and I for sure as crud don't play bonds.
And I would have an end goal, an end date, instead of just vibing, going, well, maybe a couple of years from now, just go, hey, 12 months from now,
What our amount of money?
We're gonna do this.
Says, when I get to 400K, we're going. Or when I get to 300K, we're going.
Alright guys, Dave Ramsey takes a call that sounds ordinary at first, but one shocking financial decision changes the entire convo. As the caller tries to explain their situation, Dave Ramsey exposes the costly mistakes, delivers brutal truth after brutal truth, making this an insane, yet priceless, money lesson that could change the way you think about your finances. Breaking it down on Debt Disaster Daily, subscribe for more financial chaos and truths. Guys, to those who are watching who have yet to be subscribed, I would appreciate it if you just drop that sub button right now. We're trying to hit that 500 milestone. It would mean the world to us if we do. So drop that sub button and we'll jump right in.
Got married a little over a year and a half ago, and wife and I have done pretty well, and we're trying to buy a house. We live in Orange County specifically, and it's super pricey to live here, as you probably know.
Yep.
Our goal is to buy a home. We've been smart. Our parents have raised us right. My dad put me in touch with all of your stuff, and I've been hooked to the show ever since. So it's been a pleasure and a blessing in my life and my wife's. So
well, thank you.
Yeah, so we've been smart with our money, and we feel like we've done well with it. But I'm kind of reaching a point as we get maybe a little bit closer to figure out how we should move it around from here, I guess.
Okay.
But it's currently invested in the stock market.
In what? What's that mean?
In the stock market.
I know. In what in the stock market?
So 80% is in equity investments, and then 20% is in bonds and fixed incomes.
Equity investments. What's that mean? You got it in single stocks?
No, it's kind of spread out across multiple different stocks, and the advisor that's helping me has put it in the market.
Okay. All right. Well, that's not what we teach. You know that.
Yeah, that's
okay.
That's one
okay.
thing.
That's very risky.
Yeah, it is, and it's done
and the
well.
Bonds,
the
bonds are worse.
Well.
Yeah, the bonds are risky too. Yeah. Okay.
So that's where we have it right now. I mean, we've done well with it, but the market, we're concerned that it's going to come down. And when it comes down, how far is that going to set us back? And I think it's time that we maybe reconsider where we have our money right now.
Okay.
Yeah.
I don't time the market either. So I don't know.
Right.
I would not do it based on what I think the market's going to do, because most people don't have any idea.
No one could have guessed the market was going to be up as high as it was 3 years in a row these last couple of years.
Yeah. In the last 5 years, it's doubled, and nobody could have guessed that.
Sure.
Now that's not in the portfolio you've got, but the portfolio that I've got has doubled. Yours may or may not have done that because those stupid bonds probably were an anchor on yours.
Dragging it down.
Anyway, how much is in there, and when will you be buying the house?
I've got about $250,000 in it right now, not counting like my emergency fund and other savings that we have.
Mm-hmm.
And our goal is, we're renting for really cheap from family right now, a house from one of our family members that they own. And
why, with $250,000, why have you not bought yet?
It's so expensive. Like for a single family home in our area.
It's not going to go down.
I know, but for our area, and
why, with $250,000, why have you not bought yet?
It's so expensive. Like for a single family home in our area.
It's not going to go down.
I know, but for our area, it's between 1.1 to 1.3.
I know, but it's not going to go down, and you have $250,000.
I'm in a sales role, and it's commission based, heavily commission based. So it's been kind of my goal to throw down as much as I can at a home, and since my rent is so cheap, and I'm not really pushed up against a wall to move out.
Wouldn't the other goal for you as your role as a salesman would be to bring in more commission? That's a fair question.
And I have the goal of moving out, right? We don't want to take advantage of it, but
okay. So, are you willing to trade the volatility of the portfolio that you have and the returns it has for zero volatility and moving $250,000 into a high yield savings account?
No, that was what I was kind of questioning. Yeah, is it better to have it in a high yield savings, or
if you're going to buy within
like
12 or 14 months? Yes.
Okay.
Because your heart's going to sink when 12 months from now your
It-
money's down.
You know,
and
I-
you
you know,
need it.
if the market dropped 10%, that would be like one of the worst drops in a year in history.
Yeah.
In
Yeah.
history, and that would be $25,000, which would not keep you from buying a house.
Right.
So it's
What
not
if I
that big a
told you I
deal,
was
but
thinking-
I don't know what kind of mess your portfolio is and how volatility you've got, how much volatility you've gotten yourself signed up for. But if you were just told me you're like in an S&P 500 index fund and you're just sitting there riding the actual market, I mean, it's up 10% for the year right now, today, year to date. So you have any idea what your portfolio's up this year?
I'm up at 8%, a little over 8% this
So
year.
you're not even keeping up with the basic S&P 500.
Mm-mm.
Yeah.
Probably because those bonds and fixed incomes are keeping it back right there.
Almost like what I said earlier. Yeah, you got an anchor
Yep.
on this. And you know what bond values do when interest rates go up, right?
To go down.
Yeah, they're an inverse relationship, exactly. So that's going to be bad.
We were thinking, I mean, waiting as much as...
I guess let me quit mouthing around the edges of this. What would I do if I woke up in your shoes? I would move it all to an HSA, or I would move half of it, or an high yield savings account, or I would move half of it there and the other half into just an S&P 500.
That way you get the best of both worlds.
Yeah, you got a little mix. Whatever the market does, you're going to get. But that gets rid of the S&P 500 is probably half as volatile as what you've got right now. I wouldn't be in what you've got right now for anything. I don't have a dime in a portfolio that looks like that, not one. I don't play single stocks, and I for sure as crud don't play bonds.
Single stocks, if there's not enough research made, then you're basically gambling at that point. However, if you have some research and you're invested into that research and understanding how that company's operating and whatnot, I mean, it can be less volatile, but the thing is, people just buy and they don't even think about it, and they expect the charts to go up when they don't understand the reason why they go down. Charts go up and down.
And I would have an end goal, an end date, instead of just vibing, going, well, maybe a couple years from now. Just go, hey, 12 months from now.
What our amount of money?
We're gonna do this.
Says, when I get to 400K, we're going. Or when I get to 300K, we're going. Or whatever the number is, have a name on it, and then let's go do it. Because the sense of I'm in sales and I'm scared of volatility is never going to go away. That you're going to have that as long as you're in sales. And so that's not going to change based on the expense of the real estate or based on the interest rate environment. It's not going to change based on any of that. And so, that's what I would do. I would take all the money out of that right now. I would put either all or half of it in a high yield savings and not worry about it anymore. If I put half of it in, I'd put the other half in. The most volatile thing would be an S&P 500. And I use personally an S&P 500 to park money in while I'm saving up to buy my next real estate project, which is some of my favorite investing. And so I'll let it sit there. And so I've made 10% on my money this year, that's been sitting there year to date. And I'm fine with that. And if it went down 4% or 5%, I'm not going to kill me. Be fine with
You're
that.
not desperate.
But I don't have to sit there and make, high yield savings rates, which is what, 3 or 4 right now?
Yeah. 3.5 about.
Yeah.
Somewhere in there.
So that's the thing. So
it's a good call out that we're talking non-retirement accounts here.
Yes, absolutely. And retirement accounts, we suggest putting money across 4 types of mutual funds.
Yeah, you're going to have your aggressive growth and income, and international. So that's kind of like large cap, mid cap, small cap. And we're talking about, the huge companies. Those are the safer bets. These are like the cruise ships. It's going to be hard for them to move much. And then as you get down to the small cap and these aggressive growth, it's like a jet ski. These things are moving. And sometimes it's great. Sometimes there's low lows, but you're riding that wave to capture it over a long period of time. And then international, we saw this happen. International actually went up as the U.S. market went down. So it's a good hedge against the market here stateside. So all of that helps you just sleep better at night.
All right, guys. Well, this might sound a little contrary to what they're saying. If you have the option to take a risk that'll give you a high reward, go for it. Just know what you're getting into. Stocks, they're risky. Bonds can be risky too. It all depends whether you invest in that company, whether you understand what you're doing, and you take your time to understand the process of what's going on. The same can go with finances. If you understand where your money goes, then there really shouldn't be an excuse why you should have a shit ton of consumer debt, right? And taking a loan to combat that consumer debt is just as risky as blindly picking stocks and just investing heavily on them. Because at the end of the day, you might be screwed if you don't understand what you're doing. Yeah, these guys, Ramsey will tell you to play it safe. In some cases, Myron will tell you to play it safe. Other entrepreneurs will tell you to take a risk. It is completely up to you. If you want to play it safe, that's fine. Just the fact that you know you're going to be all right in the future, it's good enough. Should be convincing enough to play it safe. So it is up to you guys. So hope y'all enjoy. This is Debt Disaster Daily. Subscribe for more financial chaos and truths, and we're out here.